You know, a lot of people tend to talk about you need to save for retirement, save for honeymoon, save for buying a house, so and so forth. And I'm quite sure many of you guys heard of a savings plan. But at the end of the day, what is a savings plan? And how does it work? Should you even get one or should you not? So many questions. Let me help you out here because today I'll be talking more about savings plan. Savings plan, also known as an endowment plan, is sometimes the investment component of a whole life insurance plan. It lets you grow your savings and receive some cash benefits on top of having overall life protection. This is partly why whole life insurance plans have higher premiums than term life insurance. How do endowment plans even work? Here are a few key components to how endowment plans work. Firstly, they provide coverage. Policyholders will pay a monthly insurance premium where a percentage of it is used for your life insurance protection component and the remainder is to use for your savings component. The amount of monthly insurance premium you pay will obviously vary based on which endowment plan you opt for. Endowment plans usually provide coverage for death, terminal illness, and sometimes total permanent disability. In short, we like to call it TPD. And this coverage will continue for the rest of your life even though you no longer need to pay premiums after you have reached like 50 years old. By then, you would have accumulated cash value that you are entitled to receive if you surrender your policy upon reaching 65 years old or 70 years old, depending on what type of plan you actually purchase. Secondly, there is an assured payout and bonus upon death. Touch wood, if the policyholder has passed away or gotten diagnosed with a terminal illness, the policy will pay out a benefit that is usually worth 105% of the premiums the policyholder paid until their death. The terminal illness benefit sum will be paid out as an extension of their death benefit. Thirdly, there is a guaranteed cash value. You hear this term a lot in endowment plans, so let me explain what it actually means. Guaranteed cash value refers to the amount of cash return you are guaranteed to receive from the policy without the non-guaranteed bonuses that you have accumulated from the policy itself. As long as you pay your premiums on time and continue with the policy till maturity, you will have guaranteed returns. But don't get this confused with the maturity value, which is the sum of your guaranteed cash value and non-guaranteed bonus you receive when your plan matures. But what are non-guaranteed bonuses? Well, there are two types of non-guaranteed bonuses, which are the reversionary bonuses and terminal bonuses. These bonuses are not guaranteed as they are influenced by the performance of your investment fund, expenses incurred by the participating fund, and insurance claim payouts for policies participating in those funds. What are the pros of endowment plans then? Some benefits of having an endowment plan include having longer, almost lifetime coverage with investment opportunities that let you grow your savings and have a guaranteed cash value with possible non-guaranteed bonus at the end of your plan's maturity. In fact, endowment plans can usually generate more non-guaranteed returns than other investment options like savings plans and fixed deposits. However, this is also dependent on the performance of the insurer's investment funds. Also, dependents can enjoy lower premiums if they are insured from a younger age as the premium prices increase as the person ages. Although the premiums remain constant throughout the term, but starting the plan later in life generally results in higher costs in terms of overall financial commitment and potentially reduced terms. So now that I've talked about the pros of endowment plans, what are the cons then? Of course, endowment plans have their shortcomings as well because firstly, there is more financial commitment. Endowment plans usually have a longer locked-in period. This means it could potentially be tough to keep up with long-term, which may become an issue if you cannot afford to pay your premiums halfway. If you cannot afford to pay your premiums halfway through, your plan will lapse and you may have to resort to loaning from your policy at an expensive interest rate that would cause you to potentially lose money. Which brings me to the second point, that endowment plans are illiquid. Because of it being illiquid, right, you will not be able to access your accumulated cash value easily unless you loan with the hefty interest rate. Furthermore, terminating your plan before maturity will let you get back part of your savings but also lose a large percentage of it. Therefore, commitment is a big part of endowment plans. Thirdly, and very importantly, your projected guaranteed return does not always equate to your actual return. Do not assume that you will always get 100% the cost of the premiums you paid for the policy because of a few main reasons. Firstly, low interest rates. The returns on endowment plans are often influenced by prevailing interest rates. Therefore, prolonged periods of low interest rate can affect the returns when the plan matures. Secondly, investment performance. Endowment plans typically invest in a mix of assets, including bonds and equities. Poor performance of these investments can impact the returns. Therefore, the insurer's choices and management play a very significant role. For example, if the premiums paid to date is $200,378, but the actual guaranteed return at maturity is only $189,000, you may be disappointed that you're getting less money in return after that long investment commitment. However, the silver lining would be that the death benefit would still be substantial, because if death occurs during the policy term, a payout of $189,000 is still given. So there's a give and take. Although you have a lower guaranteed payout, there is significant insurance coverage during the policy term. Next up, who should and should not buy an endowment plan? And how do you know if you should buy an endowment plan? Well, generally, in my opinion, the most important factor is financial goals. Say, for example, you're saving for a certain milestone, say your children's education. We all know that uni fees are getting more and more expensive. My uni fees back then in 2018 cost $64,000 back when I was studying in Australia, and I believe that it will only get higher. Therefore, if you're concerned with regards to that aspect, then a savings plan might be suitable for you. However, say if you have a pretty big commitment coming up, such as wedding, honeymoon, and renovation of your new house that requires you to have access to your money, then perhaps endowment plans are not suitable for you due to the limited liquidity and long-term commitment. If you're risk averse but want to put your money to work and need access to the money in the next few years, you can also consider cash funds such as money market funds, Singapore savings bonds, or even T-bills as well. All in all, an endowment plan is one of the ways you can get both life coverage and savings. But as the saying goes, you can't have your cake and eat it, because endowment plans also comes with its conditions and restrictions. So explore your options with different endowment plans and even other investment methods to find out what fits your angle. Be sure to also know the difference between your long-term projected returns and the actual returns that you're going to get to prevent major disappointment in the future. So previously I was talking about whole life insurance and endowment plans as well. But what is the main big difference? Because whole life insurance gives you a higher protection amount. For every dollar that you put in, you can put in $100, but the sum assured can be easily $50,000 or $100,000, because a whole life insurance places more emphasis on protection as compared to an endowment plan where there is so-called life protection in terms of death or terminal illness or total permanent disability sum assured, but it only comes in the form of 105% of whatever premiums you have paid or the account value, whichever is higher. Therefore, the sum assured for whole life insurance and an endowment plan is significantly different. And at the end of the day, it depends on what you as a client actually need. If you are looking for a wealth accumulation plan, then you should be looking for either an endowment plan or an investment plan. But if your priority is to have protection needs, then it will be a total different spectrum at the end of the day. My name is Sean, and I hope that this video was helpful for you in some way. I'll see you in the next one.